The screen goes from green to red faster than your breath can catch. You watch the 5-minute candlesticks on TradingView punch through yesterday's low, your stop loss sits 2 ticks away, and your cursor hovers over cancel. Your heart rate spikes. Level 2 prints are a blur, the bid keeps stepping down, and you're absolutely sure the next candle will wick back and prove you right. You kill the stop. Price sinks another 0.5% in 30 seconds. Your P&L flashes a red number big enough to make your palms sweat. A strange calm washes in, the kind only anger can bring. You hit a market order twice as big in the opposite direction, snapping at the chart like it insulted you. Now you're not trading the setup, you're trading your blood pressure. The spread widens, slippage takes another bite. The platform freezes for a heartbeat right as volatility surges. When it comes back, you're down enough to trigger the margin warning. You lean closer to the screen, every neuron screaming for one thing: get it back now. Here's what just happened inside you, not the market. Volatility lit the fuse. Red P&L poured gasoline. Your brain runs an ancient playbook that's lethal at a modern terminal. The moment that candle turned against your position, your amygdala labeled the loss as threat, status, safety, self-story. Cortisol spiked. Your attentional field narrowed to the last ticks on the tape. That tunnel vision is why you knew a bounce was imminent. You weren't seeing the order flow, just your pain. Then dopamine dangled relief. The fantasy of the comeback trade. The single green candle that would erase the sting and restore your identity as a good trader. That hit is powerful. It's the same operant loop that trains gamblers to chase. Add adrenaline from fast markets, and you've got the perfect biochemical cocktail for impulsive size and cancelled stops. This is entry hesitation in reverse. Not fear of clicking, but compulsion to click before your prefrontal cortex can re-enter the room. In cognitive terms, you slid from probability thinking to belief defense. The chart stopped being data and became a courtroom, where you argued with candles, confirmation bias filtered out every bearish clue, and amplified the one thing that promised relief. You watched for a reclaim of VWAP, like a lifeline, ignored the expanding range, and listened more to your self-talk than to the auction. In behavioral finance language, loss aversion multiplied the subjective weight of that loss, so the utility of getting back to even towered over the objective risk. And in trader-specific neuropsychology, each small win after a loss acts like a micro-reinforcement. Your brain learns that breaking rules sometimes feels good. That's how revenge trading becomes a habit loop. Trigger, red P&L, routine, double down impulse, stop removal, overtrading. Reward, occasional snapback win. And the belief forms, I can fight my way out. The paradox, the more you chase relief, the further you drift from the only edge that pays. Disciplined execution of a tested plan under uncertainty. Markets are random enough trade by trade that you'll be right just often enough to cement the illusion of control. Then the fat-tailed day arrives, and the habit that saved you yesterday destroys you today. Let's name the pattern, because vague language keeps traders broke. It's the revenge trading loop, and it usually rides 3 rails. First, stop-loss removal syndrome. The instant your protective order feels too close, you convert risk management into hope management. You change a defined risk trade into a prayer. On level 2, the bid's thin, you tell yourself those are algos playing games. They'll run stops and rip it back, so you make your stop invisible. The problem? Invisible stops get honoured by the market with visible drawdowns. Second, size escalation. You take the next entry with bigger size, not because the setup improved, but because the emotional need did. Your risk or reward math is no longer about the distance to structure. It's about the distance to break even. That's why your trailing logic evaporates. You aren't managing the trade, you're trying to manage pain. Third, overtrading compulsion. After 2 fast losses, time shrinks. You flip timeframes from 15-minute to 1-minute to tick charts, hallucinating patterns in noise, seeing micro double bottoms everywhere your nervous system wants them. Each market order is a scratch ticket. Some scratch tickets pay, most don't. The cost isn't just the red ticks, it's the cognitive depletion that guarantees you'll miss the clean A setup when it finally prints. Worse, volatility amplifies every mistake. Tighter stops during high ATR regimes often mean bigger losses. not smaller, because whip and slippage push you out right before the move or blow you past your planned exit before you can react. More screens during chaos mean less clarity. You drown in inputs and follow whichever chart mirrors your emotion in the moment. And the cruelest paradox of all, the perfect setup after a loss often feels the worst to take, so you pass on the trade that would have repaired the day and chase the one that promised relief. Meet Marcus, the reformed gambler. 3 account blow-ups behind him, 3 account statements burned into his memory like red-hot iron. He used to scalp the open, stacking 50 tiny decisions into one shaky morning. He thought in dollars, not in risk units. He'd stare at a 1-minute breakout under yesterday's high, cancel his stop as soon as it ticked against him, then double his size on the retest to prove the first attempt wasn't wrong, just early. On his desk he ran 4 monitors, TradingView with candlesticks, a DOM and level 2 ladder, an order flow footprint, and a chat room tab he swore he never read while in a position. His routine was chaos disguised as hustle no pre-market risk caps, no max daily drawdown hard stop at the broker, and a journal that only appeared after green days. After the 3rd blow-up, Marcus did something different. He printed his worst days and drew a red circle around the first irreversible action each time. The exact moment he moved a stop, added to a loser, or took a FOMO market order. He labelled each circle not with price, but with emotion. Shame, panic, I'll show them, must get it back. He noticed a tell. His right leg bounced under the desk right before he took revenge size. His breathing went shallow right before he deleted a stop. So he rebuilt his trading like a system trader who happens to click the buttons. At 8:30 a.m, he does a volatility scan, ATR 14 on his tickers, overnight range, expected news. If ATR is in the top quartile and spreads are wide at the open, he halves his size and doubles his initial stop distance but keeps the same R. His orders are staged. Bracket orders with a server-side stop that cannot be moved closer to his entry. Only adjusted to lock in risk after structure shifts, no exceptions. He uses alerts above or below key levels so that he doesn't chase mid-bar noise. He hides his running P&L during active trades. The only numbers on screen are entry, stop, target, and R multiple. He uses a risk unit 1R equals 1% of account on swing, 0.25% on day trades, and his platform enforces a max daily drawdown stop that logs him out if he hits -3R. Revenge is hard to do when the platform literally stops you. On his whiteboard, risk defines the trade. On his monitor bezel, past patterns don't guarantee future. Follow the plan. When he feels the leg bounce, he lifts his hands off the keyboard and reads his T-card a 4-line script he wrote while calm. 1 trade is a coin toss. 5 trades with edge is math. Breathe. Follow stops. Then and only then he decides if the next bar even belongs to his playbook. Marcus's rewiring process is brutally specific, because vague goals don't beat biology. He built pre-market, in-trade, and post-trade routines that force his brain out of fight or flight and back into probability mode. Pre-market, 15 minutes of chart markup PTHW. Symbol, top down from 4 hour to 5 minute, drawing support or resistance, overnight highs or lows, liquidity pools, and the 1 or 2 structures his setups require. For trend continuation, a pullback to the 20 EMA with RSI staying above 40 on the 5 minute. For mean reversion, a spike through an H4 level with RSI divergence and seller exhaustion on the footprint. He defines if or then conditions in writing. If we gap down into H4 demand and buyers absorb at the prior low with delta divergence, then I take the first higher low with a stop below the wick. If we trend into prior week high with rising cumulative delta and no pullback, I do nothing. In trade, he locks the P&L pane. He watches volume and delta like a hawk because they reflect acceptance better than his feelings. A trailing stop only moves with structure. Last swing, VDU app reclaim, or break of a micro trend line after partials. He sets a timer for a 2-minute breathing drill when a trade stops out. Inhale 4, hold 4, exhale 6 to downshift the sympathetic surge and widen his attention again. Post-trade, he journals like a performance coach taught him. Not win or loss, but did I follow the plan? Did I adjust size to volatility? Did I remove a stop? What was my self-talk right before entry or exit? He tags trades with biases: hesitation, greed extension, stop removal, revenge impulse, overtrading, pattern hallucination. He tallies tags weekly. If revenge tags exceed 1 in a week, next week opens with half size and a 2-hour daily stop. He treats this like professional drawdown rules, not punishment. He rehearses mentally every evening the hardest part. He sits with eyes closed and imagines the exact moment the P&L goes red and breath quickens. Then he rehearses the right behaviour in slow motion. Hands off mouse. Read T-card. Refocus on order flow. Accept the stop. He links the calm state to that behaviour so the association triggers under stress. He built a break glass protocol. If 2 stops hit fast, he must step away for 10 minutes. Coffee timer on desk. No exceptions. He also moved his identity out of the P&L. He banned daily dollar goals, process goals only. Take only A, setups, never move a stop away. Cap total trades at 5. He embraced the paradoxes. The best trades felt slightly uncomfortable because they ran against his need for immediate relief. Fewer screens gave him more clarity. Wider stops with smaller size during high ATR produced smaller losses and better stays. And the more he analysed after hours, the fewer indicators he needed during hours. He adopted a partial automation mindset. Even as a discretionary trader, he let the platform do what his biology often can't enforce rules under adrenaline. He set broker-side daily loss limits and position limits per ticker. He hid community chats while in a position to avoid mirror neuron contagion from other traders' emotions. And, because most traders lose money, he assumed every urge that felt good in the moment was likely bad for his account. He trusted rules over urges. Picture the transformation. Volatility spikes at the open and slams his first long. The platform clocks -1R. His chest tightens. His leg starts its old bounce. That's the fork in the road. He doesn't touch size. He doesn't touch the stop. He reads the T-card. He watches footprint delta flip positive while price holds above the reclaimed level. His plan calls for a re-entry with the same risk if buyers defend VWAP and the next 5-minute closes above his trigger line. It does. He clicks a smaller size because ATR is elevated, same R. He sets partials at structure half off at 1R, quarter at 2R, and lets the last piece trail under higher lows. He doesn't look at dollars, he looks at R. The first trade was a statistical outcome. The second is the same. By midday, he's at +1.5R, not because he made it back, but because he executed twice with edge and refused the red to green fantasy. A late-day squeeze tempts him to chase a third trade. He checks his journal tags in his head. Overtrading after a green recovery has bitten him before. He passes. At 3:55 p.m, he closes remaining intraday positions as his rules require. He logs the day. Stops honoured, no size escalation. 1 re-entry per plan. Emotion. Anger spike noted. Controlled. Breath helped. The P&L is just a number in the corner. The real win is keeping the feedback loop clean so that tomorrow's mind shows up unscarred. That's risk management as survival, not financial advice. Past patterns don't guarantee future results, and no script can promise profits. But the trader who builds mechanical guardrails around a human nervous system gives himself a chance. The best trades will still feel uneasy, perfect setups will still fail, and some days more analysis will still make results worse. Accept it. Your job isn't to beat volatility, it's to keep your brain from beating your account every time the numbers turn red.